about half of women, 52%, and 33% of men will need long-term care, usually in their 80s. So that's the risk. Never changed. And then about women will, on average, so the middle of the bell curve, about 2.5-year claims. Men, about 1.5-year claims. So those are your risks. And when you look at your clients with assets that you're trying to grow, you don't want them to be hit by large long-term care expenses. It was interesting. I was in prepping for this meeting with you. I looked at a presentation that I had put together, a pretty good one, about 2001. And the only thing that's changed are the numbers of the cost of care. So back in 2001, nursing homes averaged about $6,000 per month, and assisted living facilities about $4,000 per month. Today, 22 years later, those averages are $11,254 for nursing home care, and for assisted living, it says here, this is a national study, 5865, but I find in the Portland area that they're closer to 8,500, 9,000 for an assisted living facility. And so they have about a little bit more than doubled the cost of care. When you look at the annual compound inflation, that's a little under 3% over the course of these 22 years. More recently, because of inflation of all kinds, it's increased just a little bit beyond that. And then early on, when the nursing home studies were started, they were higher than 3%. But for most of the past 22 years, the average has been a little bit less than 3% per year. So what does that mean? When you look at plan design and a long-term care insurance policy, you want to look at the cost of care. So I think most people, if they end up in facilities, or I don't think, I know for a fact, it will not be a nursing home. They've become a kind of end of life, end stage, and also rehab facilities, where the long-term care stays, those that average, 2.5 years for women and 1.5 years for men. Those are occurring in assisted living facilities. And so that's the risk that I look at for people. What if you had a $9,000 per month charge to your income? Where does that come from? And for a lot of people, it comes from their assets. And so they're spending down assets. You're trying to grow them. So our work together for your clients could be that we insure some of that risk, and I help them find long-term care insurance that doesn't cover $9,000 per month, but what they couldn't afford to pay out of their income. So they might sell their home when they move into assisted living, or maybe there's a spouse at home, and so there's an income that needs to support the spouse at home. How much of the excess income, without jeopardizing assets, how much of that can go toward the cost of care? And so I help people figure that out, what they should insure. And my goal is to balance the cost of long-term care insurance with the risk that they have. So we're covering the risk that they can't afford to pay without reducing their assets. And so that's the problem-solving part of it. So when do people do this? Generally between ages mid-50s and mid-60s. That's the best time to be looking at long-term care insurance. It gets quite expensive after your mid-60s. It's not all of a sudden a a big jump, but it's a jump every year that you defer the decision. Generally around 5 to 8% per year increases once you hit your mid-60s. So in the course of only 5 years, from 65 to 70, the price will increase by 40 to 50% when you compound that out. So I look at the younger people are when they buy it, the better they are in terms of the cost of the policies. And then you have on the psychological side of it, that motivation to buy it. Well, geez, I've got kids finishing college, I'm paying off the mortgage, I'm still saving for retirement. So there comes a point in time, generally around mid-50s, when people are looking at, okay, now I can start to look at what it's going to be like in retirement. And now I see that I have this risk. And you sensitize them to that as their primary financial advisor.